Hello and welcome to Financial Market Insights for Traders. I'm Sophia, and today we're going to explore one of the most important and often least understood forces behind financial markets: liquidity. When traders and investors talk about what moves asset prices, the conversation usually starts with familiar subjects. We hear about inflation, interest rates, economic growth, company earnings, employment data, central bank decisions, geopolitical developments, and investor sentiment. All of those things matter, but there is another variable sitting underneath many of these forces that deserves much more attention. That variable is liquidity. And today we're going to look closely at the relationship between liquidity and asset prices, why liquidity can influence stocks, bonds, credit, currencies, commodities, and other financial assets, and why I believe liquidity may be the most overlooked macro variable for traders and investors. We'll also talk about liquidity macro investing, how traders can monitor liquidity conditions, why liquidity isn't simply the same thing as money printing, and why understanding the direction of financial conditions can sometimes provide important context before the economic data catches up. So let's get started. What exactly is liquidity? Before we talk about asset prices, let's define liquidity in simple terms. Liquidity generally refers to the availability of money and credit within the financial system and the ease with which capital can move between different investments. Imagine a financial system where banks are willing to lend, borrowing costs are relatively low, investors have capital available, and market participants are comfortable taking risk. That's generally a more liquid environment. Now imagine the opposite. Banks become more cautious, lending standards tighten, borrowing becomes more expensive, investors raise cash, credit becomes harder to obtain, risk appetite declines. That's a tightening liquidity environment. And this matters because financial markets depend on capital. An asset can have strong fundamentals, but ultimately someone still needs to be willing and able to buy it. That's where the relationship between liquidity and asset prices becomes so important. When more capital is available and investors are willing to deploy it, demand for financial assets can increase. When available capital contracts, demand can weaken. This doesn't mean that every asset automatically rises when liquidity expands or automatically falls when liquidity contracts. Markets are much more complicated than that. But liquidity can create the financial environment in which those assets are priced. Think of liquidity as the tide. One way I like to think about liquidity is as the tide underneath the financial markets. Individual stocks can rise or fall because of company-specific news. Bonds can move because of changing interest rate expectations. Commodities can react to supply disruptions. Currencies can respond to changes in monetary policy. But beneath all of these individual markets is a broader financial environment. When liquidity is abundant, investors may be more willing to take risk. When liquidity becomes scarce, investors can become much more defensive. This can influence the behavior of entire asset classes at the same time. For example, an environment of improving liquidity might coincide with stronger equity markets, tighter credit spreads, lower volatility, and increased demand for higher risk assets. A deteriorating liquidity environment can produce the opposite pattern. We might see equity weakness, wider credit spreads, increased volatility, weaker speculative assets, and a greater preference for cash or high-quality government bonds. Again, liquidity isn't the only explanation, but it can help explain why several markets sometimes move together. Liquidity is not just money printing. Now, there's an important misconception that we need to clear up. When people hear the word liquidity, they often immediately think about central banks printing money. Central bank policy absolutely matters. Central bank balance sheets, quantitative easing, interest rates, and other monetary policy tools can have major effects on financial conditions. But liquidity is much broader than that. Commercial banks create credit through lending. Governments influence financial flows through taxation and spending. Treasury cash management can affect liquidity within the financial system. Money market funds move capital between different instruments. Financial institutions adjust leverage. Investors decide whether they want to own risky assets or hold cash. All of these things can influence the availability and movement of capital. So, if you're trying to understand how liquidity affects stock prices, looking at one central bank balance sheet chart isn't enough. You need to consider the wider financial system. A central bank could maintain a very large balance sheet while banks become more cautious about lending and investors reduce leverage. In that situation, headline monetary liquidity might look substantial, but financial conditions could still be tightening. This distinction is extremely important for anyone studying macro markets. What is liquidity macro investing? This brings us to the concept of liquidity macro investing. Liquidity macro investing is essentially the process of understanding how changes in money, credit, financing conditions, and risk appetite can influence different financial markets. Instead of looking at one company and asking, is this stock cheap or expensive? A macro investor might first ask, what kind of financial environment are we operating in? Is liquidity expanding? Is liquidity contracting? Are credit conditions becoming easier or more restrictive? Are investors increasing their willingness to take risk? Are interest rates moving in a way that supports or challenges valuations? These questions can help investors understand the broader market regime. A liquidity-focused trader might monitor central bank balance sheets, policy rates, real interest rates, bank lending, credit growth, credit spreads, government fiscal flows, money market conditions, volatility, currencies, and financial condition indexes. No single indicator provides the answer. The goal is to build a broader picture. Why liquidity can move markets before the economy does. One of the most fascinating aspects of liquidity is that financial markets are forward-looking. Markets don't wait for economic statistics to tell them what happened. They constantly attempt to price what investors believe will happen next. Suppose traders begin to expect that a central bank will eventually lower interest rates. Bond markets may respond first. Investors might buy government bonds, pushing prices higher and yields lower. Then equity investors may reassess valuations because the expected discount rate has changed. Credit markets may begin pricing easier financing conditions. Currencies may respond to changing interest rate expectations. And eventually, those financial market changes can influence the real economy. This is why liquidity as a leading indicator for asset prices can be so interesting. Markets can begin reacting to anticipated changes in financial conditions before those changes are fully visible in traditional economic data. That doesn't mean liquidity gives us a perfect forecast. It means liquidity can sometimes provide an earlier lens through which to interpret what the market is already anticipating. Liquidity and interest rates. Interest rates are one of the most important channels through which liquidity affects markets. When interest rates decline, borrowing costs can fall. Companies may find it cheaper to finance investments. Consumers may have greater access to credit. Investors may reassess the attractiveness of bonds relative to equities and other assets. Lower interest rates can also affect valuations. The value of an investment depends partly on how investors value future cash flows today. If the discount rate changes, the present value of those future cash flows can change as well. This is one reason liquidity, interest rates, and stock market valuations are closely related. Growth companies can be particularly sensitive to these changes because a larger portion of their expected value may depend on cash flows far into the future. But here's an important point. Falling interest rates aren't automatically bullish. Sometimes rates fall because the economy is weakening. If borrowing costs decline because investors expect a serious recession, falling rates may not be enough to support stocks. Corporate earnings could deteriorate. Credit risk could increase. Unemployment could rise. Investor confidence could collapse. So, once again, context matters. The question isn't simply, are rates falling? The better question is, why are rates falling and what is happening to the broader liquidity environment at the same time? Liquidity and equity valuations. Liquidity can also influence how much investors are willing to pay for stocks. Imagine two companies with identical long-term earnings expectations. If investors suddenly become more comfortable taking risk and financing conditions improve, they may be willing to pay a higher valuation multiple. The underlying business hasn't necessarily changed. What has changed is the financial environment. This is why markets can experience substantial valuation expansion without an immediate equivalent increase in corporate earnings. The opposite can also happen. A company can continue producing solid profits while its share price falls because investors are demanding higher returns for taking risk. This is one reason how liquidity affects stock market valuations is such an important subject. Fundamentals matter, but the price investors are willing to pay for those fundamentals can change dramatically depending on the financial environment. Liquidity and credit markets. Now let's move beyond stocks. Credit markets are particularly useful when studying liquidity. When liquidity is abundant, investors may be more willing to accept credit risk. They might purchase corporate bonds with lower yields because they believe the risk of default is manageable. That can push credit spreads lower. Companies may then find it easier to refinance existing debt or raise new capital. But when liquidity deteriorates, investors can become more cautious. They may demand greater compensation for taking credit risk. Credit spreads can widen. Financing costs rise. Companies with weak balance sheets can come under pressure. And if the process becomes severe enough, tightening credit can feed back into the economy itself. This is why monitoring liquidity and credit spreads can be useful for traders looking for signs that financial conditions are changing. Credit markets can sometimes reveal stress before it becomes obvious in headline economic statistics. Liquidity and investor psychology. Liquidity also affects psychology. When markets are rising and capital is readily available, investors can become increasingly comfortable with risk. Success attracts capital. Capital pushes prices higher. Higher prices reinforce confidence. Confidence attracts more capital. This can create a positive feedback loop. The same mechanism can work in reverse. If liquidity contracts and asset prices begin falling, investors may reduce risk. Leverage traders may have to sell positions. Portfolio managers may raise cash. Risk limits may be tightened. That selling can push prices lower, which can trigger further risk reduction. This is one reason liquidity-driven market moves can sometimes become much larger than the initial change in financial conditions would suggest. Leverage and psychology can amplify liquidity shocks. Why liquidity may be the most overlooked macro variable. This brings us to a key point. Why do I describe liquidity as the most overlooked macro variable? Because investors often focus on individual pieces of the puzzle without looking closely at the flow of capital connecting those pieces. Inflation gets enormous attention. Employment reports can move markets instantly. Central bank meetings are closely followed. Corporate earnings dominate financial headlines. But liquidity can influence all of these areas indirectly. Monetary policy affects borrowing costs. Borrowing costs affect credit. Credit affects investment and consumption. Government spending changes financial flows. Investor risk appetite affects asset allocation. And asset allocation affects prices. Liquidity therefore provides a way of connecting monetary policy, financial conditions, investor behavior, and asset prices. It doesn't replace fundamental analysis. It complements it. How traders can track liquidity. So, how can a trader actually use this information? You don't need a massive institutional research team. You can begin with a simple liquidity dashboard. First, monitor central bank policy and balance sheet trends. Second, watch interest rates and real yields. Third, examine bank lending and credit growth. Fourth, monitor credit spreads. Fifth, pay attention to government and fiscal flows. Sixth, watch broader financial condition indicators. And finally, compare those developments with what markets are actually doing. Are equities strengthening? Are credit spreads narrowing? Is volatility falling? Are cyclical assets outperforming defensive assets? Are speculative assets gaining momentum? Are currencies responding to changing interest rate expectations? The goal isn't to create a perfect mathematical model. The goal is to determine whether different signals are telling a consistent story. If liquidity is improving and multiple risk assets are responding positively, that can strengthen the case that financial conditions are supportive. If liquidity is tightening while credit spreads widen and volatility rises, the environment may be becoming more challenging. Liquidity is not a perfect trading signal. There is one final warning. Liquidity should not be treated as a mechanical buy or sell signal. Markets can rise during periods of tightening liquidity. Markets can fall during periods of improving liquidity. Other forces can dominate. Valuations can become extreme. Earnings can surprise. Geopolitical events can change expectations. Government policy can shift suddenly. Investor positioning can create temporary distortions. There can also be a significant lag between changes in liquidity and changes in asset prices. That's why liquidity is best viewed as a macro regime indicator. It helps answer the question, what kind of environment are financial markets operating in? From there, traders can combine liquidity analysis with technical analysis, valuation, earnings expectations, positioning, sentiment, and disciplined risk management, bringing it all together. Let's summarize the key idea. Financial markets are ultimately markets for capital. Prices are influenced not only by what an asset is worth fundamentally, but also by how much capital is available to purchase that asset and how willing investors are to take risk. When liquidity expands, financial conditions can become more supportive. When liquidity contracts, financial conditions can become more restrictive. The transmission isn't always immediate, and it isn't always straightforward, but the relationship between liquidity and asset prices, is too important to ignore. For traders interested in liquidity macro investing, the objective isn't to predict every move. It's to understand the environment. Is the financial tide rising or falling? Are markets responding to that tide? Are fundamentals confirming the move? And perhaps most importantly, is liquidity supporting the trend or quietly working against it? Those questions can help traders develop a more complete view of financial markets. If you'd like to take your market analysis from theory into practice, explore the Crystal Ball Markets trading platform at crystalballmarkets.com/platform. It's a world-class, cutting-edge, user-friendly trading platform app designed for traders and investors who want to engage with financial markets. Visit the platform today and start putting your market insights into action. And if you're still building your understanding of markets, make sure you check out the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. You'll find beginner-friendly podcasts covering trading, investing, macroeconomics, and financial markets, making it a useful resource whether you're just getting started or looking to strengthen your existing knowledge. Listen today and build a stronger foundation for understanding what really drives markets. That's all for today's episode of Financial Market Insights for Traders. I'm Sophia, and remember, don't just watch the price. Look underneath the price. Look at the capital flows, the financial conditions, the credit environment, and the liquidity supporting the market. Because sometimes the most important market signal isn't what investors are buying. It's how much liquidity is available to keep buying. Thanks for listening, and I'll see you in the next episode of Financial Market Insights for Traders.